So one of the other things we wanted to touch on today was discussing some of the behavioral biases that investors face. And these aren't new, or they haven't just kind of popped up since the beginning of last year, but we think some of them have kind of been exacerbated further and led to some of the conditions that we're seeing right now. So we want to just touch on a few of these. We'll probably put a more comprehensive presentation focused on behavioral biases here in the next few weeks, and we'll certainly let you know when we get that out. But for now, let's start with the recency bias. So this is the tendency for an investor to weigh recent information more heavily than anything else. So if you think back to 2020, for a majority of the year, the dominating return factor was mega cap tech, NASDAQ. And that had kind of been the dominant theme for the greater part of the decade, along with some of these other ones. I think investors just got really comfortable with the fact that these trends will not change at all. So just to name a few here, you have rates can't go up. Well, rates are going up now. Tech is indestructible. We're seeing a little bit of wobble there. Foreign stocks never perform well. Foreign stocks have paced US stocks pretty closely over the past 6 months. And then 2020 is the new normal. So basically a series of outlier events in 1 year is going to be what the market's going to look like for the next decade. So what happens is investors take these themes and they readjust their portfolios to reflect those and kind of put undue risk onto themselves. So I understand that it's probably hard to read this chart and all these numbers, but this is what we call a Quilt Chart. And it goes back to 2006, basically ranks all of the major asset classes in the marketplace by return. And what we did here was just kind of show an extreme example of how this can play out. So the line that you've got running through here in these white boxes is simply an asset allocation. So it's, I believe, a 65-35 weighted portfolio that's rebalanced annually. So for an investor who just followed that, strictly kind of very hands-off, the annual return over that time period was 6.7%. So pretty normal return. Now, the recency bias return would be, and if investor, and again, I understand this is an extreme example, but I think it illustrates the point. If an investor would have taken 100% of their assets and invested it solely in the asset class that performed the best the year before, their annualized return over that time period would have been negative 0.55. So think about what the market's done over the past 15 years. It's done pretty well. And to generate a negative return over that time period with a strategy like that is kind of crazy. So, I think there's probably a lot of recency bias being implemented in the market right now. And it will be interesting to see how that continues to play out if these trends kind of continue to move in opposite directions. So next is the confirmation bias. This occurs when people observe, overvalue, or accurately seek information that confirms their claims while ignoring or devaluing the evidence that discount their claims. Now, normally we stay away from politics with a 1,000-foot pole, but I think we're gonna pick on both sides of the aisle here. So I think we're fair game. There's no scientific study around this, but I think everyone can agree that if you are lean to the Republican side, you may view Fox News. If you lean to the Democratic side, you're more inclined to watch MSNBC. And why is that? Because those networks generally cover topics that reinforce beliefs of each side of the political aisle. And what happens is that we never really get the other side of the story, so to speak. So, for us, when we have, investment thesis or ideas, and we're searching for articles of research, and we're starting to see a lot of people agreeing with us, that gives us a little bit of pause and says, okay, maybe we need to take a step back and find the other side of this to kind of understand the pitfalls and the risks. And I think another thing that in the market leads to confirmation bias is price. And there's a saying that price affects sentiment more than anything else. And I think that some of the pricing that we saw last year and into the tail end or into the beginning of this year has certainly caused some investors to maybe move into some asset classes that have been a little bit more risky than they expected.